how to reduce your capital gains tax on investment property legally or illegally.
Legally, not like this cheeky bugger.
Who?
That Macaulay Culkin kid, mate. Straight up criminal, mate. Tax evader.
You know it's a movie, it's not like a hidden camera show.
Well, if that is true, let's deep dive into some of the best ways to massively minimise your capital gains without being a tax evader. I'm Macaulay Culkin. You know the law, mate. Guilty until proven innocent.
And let's start by just forgetting about tax. Just get to understand what makes up capital gains. And then let's just simply reverse engineer to get the best solution for you.
Do you want to save thousands, possibly tens or hundreds of thousands in the millions, if you're considering selling an investment property down the track? Or do you want to not pay tax on capital gains altogether?
If so, stay until the end as we reveal our top 5 tips to reduce capital gains tax or even give it the boot altogether. Bring it! We covered why capital gains tax is not a tax in our part 1 video, which if you haven't watched, you can click here. If you still think that capital gains tax is a tax and not a tax on capital gains, then click here.
You're loco. I'm gonna get a Spanish subscriber one day, mate.
Let's just start off by simplifying things. Know that capital gains is made up of 3 main components. 1, cost base. 2, ownership. 3, time. Now, while ownership and time might be a little bit more self-evident, cost base, dive into this more shortly. Tip 1, never sell. Just never sell.
Some may see this as obvious, but it's an important foundational tip, as the tax on capital gains is payable upon selling.
The 12-month rule discount. With a property deal, with a property acquisition, startup costs and exit costs are next to inevitable.
But if you wait 12 months before selling your investment property after your purchase date, you will not be taxed on 50% of your capital gains and only be taxed on the remaining 50% of your gains. Here's an example for you. So if the gains turns out to be $100,000, $50,000 will be tax-free. The other $50,000 will be added to your annual income tax and then will be taxed at your marginal tax bracket. More on cost base shortly. Okay, the 2 most common tips are over. It's time to really get into it.
Do not make your principal place of residence partly an investment property.
Tax on capital gains is only payable on an investment property. False!
If you have lived in one principal place of residence from day 1 till the day you sell, it's true, you will not pay any capital gains tax. 0. Zip.
But in this tip 3, we're going to reveal that if you lease part of your house out for business purposes, for example, a home office, this will make some capital gains payable. Or if you live in your principal place of residence and then subdivide and separate your backyard off to sell, you've just made some capital gains tax payable.
So unknowingly, you will have turned your principal place of residence into partly an investment property.
Mind blown, we're only just over halfway. Let's keep going.
Tip number 4, the 6-year rule, or temporary absence rule.
If a property was originally your principal place of residence and you then move out, and then you rent out your principal place of residence, you may for 6 years still call that principal place of residence your principal place of residence. If you haven't claimed another residence as your principal place of residence, you can only have one principal place of residence at one time. Not hard.
You may have moved overseas, you may have moved in with your parents, or just had to rent out a place due to work requirements. You'll still be able to completely wipe out your capital gains tax within that 6-year period.
Boom.
Tip number 5, purchasing a property in your self-managed super fund can eliminate capital gains tax on an investment property. I'm not sure if this is a strategy or more of a bonus because not a lot of people can predict 25 to 40 years in the future.
The next month, to be honest.
If you purchase an investment property into your self-managed super fund and then you enter the retirement phase, you have rendered your capital gains to 0. There
he is again, evading capital gains tax, mate. I know we've given 5 awesome tips, but we need another video. We need more tips and a little bit more time to conclude my investigation into Macaulay Culkin.
If you think that capital gains tax is still a tax, then click the video link. If you want more tips on reducing or even eliminating capital gains tax, then click the video link.
I might have missed out on Macaulay Culkin this time, but I'll get you next time, Macaulay. Next time.
I'll get you next time, Gadget. Next time.